Hi, this is Michael Joyce from Agili, your personal CFO, and I'm pleased to share with you our thoughts and viewpoints for the summer of 2020. I saw a cartoon the other day that equated the year 2020 with an ice cream flavor, and they said if 2020 was an ice cream flavor, the flavor would be liver and onions. And other than my in-laws who really do like liver and onions, I think we can all agree that this hasn't been the best of years. 90 days ago, we were coming off really a horrendous period for the economy and for the markets. I said at the time that we were already in a recession and that unemployment was about to spike, the highest level that we'd seen since the Great Depression. And indeed, there has been a lot of economic distress. Although unemployment didn't get quite as bad as a lot of economists and pundits had predicted, mainly in our opinion because of some of the fiscal stimulus, such as programs like the Paycheck Protection Program. 90 days ago, we also thought that the market was oversold and that there was a lot of opportunities around. There was also a lot of short-term uncertainty, and there still is. So in the ensuing couple months, the markets have rallied. And although I still think that we're going to be in a much better place a year from now, I really didn't think that we would recapture so much of the downturn in such a short period of time. In fact, right now, we see a wider range of potential outcomes for the economy and the financial markets than we've seen in 10 or 12 years, in quite a long time. At Agili, we're looking at a lot of different scenarios, and some scenarios are really quite bad. You know, there's scenarios that have coronavirus spiking around the world where economies shut down, and that type of scenario is not really priced into the stock market at the current time. There's also some very good scenarios out there, like what if there's a medical breakthrough with vaccines or some of the medications that might mitigate both the effects and the mortality of the coronavirus. With something like that, you could have the unleashing of a lot of pent-up demand, and that can really cause a melt-up in the markets. There's also a lot of volatility in the markets right now. It really hasn't calmed down a great deal. So we think right now we can use volatility to our advantage. We're making extensive use of limit orders and also averaging into some equity positions as time goes on. Right now, there's really three potential very positive things long-term for the stock market. You know, one is very low interest rates. As I'm recording this video, the yield on the 10-year Treasury note is about 0.7%. On short-term Treasury notes, it's more like 0.1%. So you have a lot of really good dividend-paying stocks that are paying 3% and 4% and sometimes even 5% dividend yields. And these are sustainable dividends. I mean, these are being paid by companies that have paid dividends through good times and bad times. And I think once the coronavirus subsides, the coronavirus crisis subsides a little bit, those types of dividend yields are going to look very attractive relative to the under 1% yields that you see on very high quality bonds and treasury securities. Another factor is lower energy prices. You know, energy prices really fell considerably as demand crashed in the wake of shutdown orders and the coronavirus crisis. So they've come back a little bit, and they're probably right now in equilibrium, but this has been a good thing for, and will continue to be a good thing for businesses and for households. You know, businesses have lower shipping costs, lower transportation costs, and that's going to help their earnings. For individuals and households, paying less for energy means they have more disposable personal income. And a third factor that's very good, that bodes well for the long term, is that there is currently $4.5 trillion, that's trillion with a T, that's sitting in cash and cash equivalents right now, earning about zero. And if there are very positive news that comes along at any time, a lot of that money is going to move into risk assets, including the stock market. Now in the bond market, as I said, treasury yields are really pretty low. And 90 days ago, there had been a lot of selling off of all sorts of other types of bonds, like corporate bonds and municipal bonds. And that created an opportunity, but some of that opportunity has now gone away. Credit spreads have tightened pretty considerably since that time. And a lot of that is due to some of the Federal Reserve's actions, most notably their role in kind of backstopping the corporate bond market and backstopping the municipal bond market. I mean, there's still some opportunities out there, and it's probably better than they were throughout 2019 and before the COVID-19 crisis back in January and February. But it's not quite as good of an opportunity as it was at that time. So what else can you do from a financial standpoint? Well, I'll talk about a couple things. One thing is, as interest rates have come down, mortgage rates have also come down. So it's a good idea to at least shop around and see if it makes sense to refinance your mortgage right now. And remember, it's not necessarily a lower interest rate that's going to help you. It's paying less in interest. A second thing to consider is doing a Roth conversion. You know, a lot of people are going to be in a lower tax bracket this year. So if you convert some of your IRA money into a Roth IRA, you pay taxes currently on the amount that you've converted, but that money will go in a Roth IRA, will continue to grow, and whenever you take it out, if you ever take it out, it's going to be tax-free. So a good strategy might be to look at, with your financial strategist at Agili, look at how much can you convert into a Roth IRA and stay in the same tax bracket. Those that might be paying a Medicare premium, those are collecting Medicare, you also have to be careful that you don't trip up higher Medicare premiums when you're converting a Roth IRA. So again, it's a good idea to talk to your financial strategist at Agili. And the last thing I'm going to talk about is for those people that take required minimum distributions from their retirement accounts. They may already know that required minimum distributions have been suspended for 2020. But there's some people that took some distributions before required minimum distributions were suspended. So that's going to be taxable income. And just last week, the U.S. Treasury has finalized some rules that said that if you want to, you can actually put that money back into your IRA and thus avoid the taxes, but you have to do it by the end of August. So again, something to talk about with your financial strategist at Agili. So I've been very pleased to share with you some of our thoughts and viewpoints for the summer of 2020. I hope everybody stays safe, hope everybody washes their hands, but has a great summer. And if you have any questions, please feel free to contact your financial strategist at Agili or to contact me. Thanks. Have a great day.